Good morning. Today we are going to present about our mutual fund for Gen Z. First, what is a mutual fund? A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. This is one of the safest ways to invest since the risk is very low compared to other types of investment. So it is appropriate for those new investors in the market. For example, people in the age between 18 to 40 years old, or what they call Generation Z. So what we do is design the best mutual fund that is most suitable for them. But before anything, we need to know more about Generation Z first to satisfy their intention to invest for their future gains. Generation Z's investing behavior is different from other generations. First, they prioritize growth and passive income. So the stocks are their first priorities. According to the research, 73% of Gen Z investors overall own stocks, making them the most common type of investment in this age. Moreover, people in this generation pay more attention to the cryptocurrencies than the older ones, so that cryptocurrencies move toward the mainstream, as 47% of them said they hold this new asset. If they choose to invest in our funds, we are sure that we can capture the trend of Generation Z's aspect towards investment and fulfill their dreams.
The location that will be attractive to Gen Z is dividing the investment into two parts, which are stocks and cryptocurrencies. Firstly, cryptocurrencies are new and interesting for people at the age at are highly adaptive and able to bear the risks. Secondly, the stocks are more stable and can be expected to earn certain return in futures. To be precise, we allocate 7 cryptocurrency combined with 8 stocks from different sectors to have an overall of 15 investment. As you can see, we prioritize more on stock, which is more stable because from our perspective, a group of people in Generation C is around 18 to 30 years. The financial state of these people is still not stable, so we will do our best to reduce the excess risk. For portfolio optimization, there are 3 types of portfolio designs for 3 different types of investor, including low risk or risk reward investor, medium risk investor, and value investor who focus on their return regardless of how high the risk will be.
We selected 8 stocks from 6 different sectors, which are SPI from the commercial sector, TCC from the energy sector, TKS from media and publishing, STA from agricultural business, Ford and SVOA from technical information and communication. Lastly, WIPA and BCH from the healthcare service sector. All of these sectors are in the current trend related to Gen Z, who was born during the digital and technology era and are forecasted to prosper in the future. We selected 7 cryptocurrencies, which are BTC, BNB, ADA, XMR, LTC, XLM, and ETH that are projects related to blockchain technology and decentralized exchange.
The reason why we decide to invest in the selected stock and cryptocurrency are that they satisfy our constraint. First, the profit of those stock and cryptocurrency has to be more than 0 or positive. Second, the debt to equity ratio from last year has to be less than 51 because it means that the debt is not too high and result in less risk. Lastly, the stock or cryptocurrency has to have at least 0% return with 95% confidence. So we can make sure that we will get positive net profit from investing in this security. The first portfolio is a portfolio with minimum variance for risk-averse investor. To explain in detail, we plan to invest in Bitcoin for 10%, Cardano for 2%, Monero for 6%, and Ethereum for 2%. And for the stock, we will invest in each Ford, SVOA, TCC, SPI, BCH, VPA, TKS, and STA for 10% accordingly. Hence, we will not invest in BNB, LTC, and XLM. The average return per day on this portfolio is 0.18%, and the standard deviation of return per day is 1.36%.
The second portfolio is a portfolio with the minimum variance and 10% expected return per year. We decided to invest in BTC, LTC, Ford, SVOA, TCC, SPI, BCH, VPA, TKS, and STA for 10% and not invest in ETH, BNB, ADA, XMR, and XLM. The average return per day on this portfolio is 0.17%, while the standard deviation of the return per day is 1.4%. The third portfolio is a portfolio with the maximum expected return to standard deviation ratio for the value investor. This type of investor focuses on gaining high returns without worrying much about the risks, like the concept of high risk, high return. Therefore, we plan to invest in BNB for 9%, ADA for 10%, ETH for 10%, and the stocks we will invest in Ford, SVOA, TCC, SPI, TKS, and STA for 10% respectively. Then invest in BCH for 3% and VPA for 8%. Hence, we will not invest in BTC, LTC, XMR, and XLM. The average return per day on this portfolio is 0.28%, and the standard deviation of the return per day is 1.82%.
The systematic risks refer to the risks inherent to the entire market, unlike unsystematic risks, which occur from the mistake of specific firms. It is the risk that cannot be avoided or diversified, so the investor should be rewarded if they hold the stock of a firm with high risk. We can see how risky it is by the beta. The higher beta means the more return of stock changes when the market return changes. To compare between three portfolios, it can be observed that each portfolio is designed to satisfy investors who have different constraints. The first portfolio has a significantly low standard deviation and yield the lowest risk compared to others, and it gives a higher return than the second portfolio. Also the value at risk for the portfolio is minus 0.42%, and tail value at risk is minus 1.03%. The second portfolio has a significantly high return. However, it uses a higher standard deviation or higher risk than the first portfolio. The value at risk for the portfolio 2 is minus 0.79%, and tail value at risk is minus 1.42%, which is greater than that of the first portfolio, referring to more loss. The third portfolio used the highest return along with the highest risk among the three portfolios. The value at risk for the last portfolio is 0.39%, and the tail value at risk is minus 0.43%, which is the less than that of the second portfolio, referring to the less loss. In our case, portfolio 1 has the lowest beta, which is 0.0381, and the second portfolio is 0.0397 beta, and the third one is 0.0386 beta. All of our portfolio have very small differences between their beta, so we can say that the systematic risk of our portfolio is indifferent. And that is all for our presentation for today. Thank you for listening ครับ ขอบคุณครับ